Our next speaker will be Bill Angrove, and I learned something recently that I didn't know about him. He was in the commercial arena for 10 years before he joined asset preservation. I think that's great. So he comes to us as kind of one of our own just on the commercial side. So now present Bill Angrove.
So I first submitted 30 slides to Joel a couple days ago, and he sent it back and said I had modified it a little bit. He said, I cut it down to like 5. So I have 30 minutes worth of information, which I'm going to get in 15. So my goal is to try to talk as fast as Danielle did. So hopefully I'll keep up. Just a little bit of my background. Joel said I was in the commercial brokerage world for 10 years with a company called Bishop Hawk. Did you recognize that name? Thank you, of course. And since then, I've now put in 21 years in the exchange industry. Asset preservation's been around for almost 30 years now. And all we do is help people in 1031 exchanges. Anytime that you're selling a property, it's not your primary residence. You can sell that investment property to defer your taxes, both state and federal, and buy new investment property anywhere in the United States. How many have been involved in the exchange in the last year or two? Okay, so some of you, this may be a new topic, so I want to make sure that we get everybody covered. What are your options in selling appreciated property? Of course, 1031 exchanges is Internal Revenue Code Section 1031. We've got 1033. I actually talked to a person yesterday. They had lost their house in a fire, and so they were wanting what to do with their insurance proceeds from the fire. Well, they can use Section Code 1033. Don't need us. It allows them for 2 years to reinvest that money into another property. Of course, the primary residence rules, Section Code 121, which is a $250,000 to $500,000 exclusion. Some of you may or may not be aware of installment sales, but if you talk to someone like Eric and some of the investment group people here in the room, they can talk to you about that. And then Section Code 721, which is selling property to an UPREIT, and that's a little more reading down the road. So we've had the perfect storm for 1031 exchanges for post-recession. We've seen some changes that happened. We had an increase in 2013 in long-term capital gains. Many of you know that it's 15%, but you don't know maybe it's now that it's 20% if you have gains in excess of $450,000, and I'll cover that in just a minute. We've had very strong residential and commercial markets nationwide, and we're selling and looking for different ways. So my goal here is to talk about some of those trends we're seeing in the 1031 world these days. I'm going to mention something called a Delaware Statutory Trust. How many of you have heard that term? Okay, that's another option other than just buying more real estate. And some of you may be tired of what I call the T's: tenants, toilets, termites, trash, and taxes. So the Delaware Statutory Trust is one of those options like a tick. So let's look at capital gains as you see up there. How many of you are familiar with the 3.8 net investment tax? Have you heard that term? So we've got long-term capital gains taxes, you've got depreciation recapture, and then you may also know this as Obamacare. So Obamacare said if you've got income over 200,000 single or 250, you married, family, jointly, we're going to tack another 3.8%. So it's not just 15% when you sell, it could be as high as 23.8%. Plus we have state taxes. And you can see the different levels. Many people don't realize that depreciation recapture is a very big tax. And usually what happens is they call us the day before they close escrow, right? My title company people in the room, because they finally get hit with that Form 593 that says California is going to withhold 3 1/3 of the total sales price as a prepayment of your California tax. And then we get the call, we're sitting at the closing table and this person has just decided to do an exchange. Our last minute exchange is possible, yes. But if you close escrow and decide after the fact, you're going to be paying those taxes, both state and federal. So if you're new to 1031s, it's got to be set up with a qualified intermediary prior to close of escrow. I'm not going to get too much into what has happened. This is talking about commercial trends, talking about values. Commercial is still cranking along. I'm very involved in the commercial real estate industry in the area here. They're staying strong. Apartments, and the big one is industrial these days. Lack of industrial and being built as well as being sold, so that's a hot market, not so much apartments. I'm going to skip on the residential because Ryan covered that in pretty much in his detail. So exchanges have been around since 1921. This is not a new phenomenon. And I bring that up because they almost went away with tax reform. The federal government, our Congress, decided that, you know, if we're going to lower corporate tax rates from 30+% down to 21%, we're going to need to give up income in another way. They targeted 1031 exchanges because they saw us as a $46 billion industry. What came out of tax reform is you can no longer do an exchange on personal property. Well, how would that affect you as real estate owners? Not so much, but for the people that own hotels and motels, your farmers, your vineyards, they have what? Machinery and equipment. You have investors that own gold coins. We did an exchange for an investor here in Sacramento. He had a 1965 convertible Ferrari, $700,000 car. In personal property exchanges, you could sell personal property and buy exact like-kind personal property. All that was eliminated in 2018 with tax reform. So it's only real property for real property these days. This is the only graph I'm going to put up, although Brian had about 20 of them. This is the only one you're going to see in the 1031 world. Does this look familiar to what you've seen already today? This is a snapshot of 1031 exchanges nationwide. They took a survey of our industry, of everybody that does what we do, and they realized, this is the Federation of Exchange Accommodators, the survey came out that the industry was off by 75%. Right down there, 2009, 2010. Is what you can also see is our peak was right there at 2005, just like the residential market. But what you will also not see is the amount of exchanges have not come back, at least on a national level, to where we were in 2005. So that's kind of an interesting phenomenon that I've realized on a national level. But if you were to overlay California, California's peak would be just below the 2005 in 2018. So we've come back in California. Most of our exchanges nationwide are done here in California. We do a lot of them here in Northern California because this is our national headquarters, of course. But California is still, and has always been, the leader in the 1031 world. When I got into the industry in 1998, the people back east and Midwest didn't even know what 1031 meant. Now they're doing a lot more of them, but not comparatively speaking. So California's come back. So the other thing I want to point out is we are seeing a number of exchanges out of state, go figure. So what are some of the main areas you think that people are exchanging to? Anyone? Florida, Idaho, Texas, Nevada, Oregon. Those are pretty much the top 5 that we see people doing exchanges. And what do you think they're going to do? Because you cannot live in your new property when you buy it in exchange. It needs to be held for investment. So one of my slides up here, I'll probably skip through it, is how long do we need to hold it for before we can convert it to a primary residence? It's always a common question because they're tired of California's tax laws, whatever the other issues are in California, and they want to go out of the state because it's going to be better there. So there is no answer to that question. A lot of people say, well, a year and a day, or 2 years you hold it as an investment property. Those are good ideas, but nothing set in stone. If you ask the IRS, you should never have the intent to move into the property at any point in time. The intent is the property needs to be held for investment. But that's what we're seeing. And you really see that a lot with the Bay Area people coming over where they've got maybe a primary residence and then they turn it into a rental because they moved to Del Webb here in Roseville. But their basis is $165,000 and they're selling today with 1.5. They have a problem because they can't take the primary residence exclusion, or if they can, let's say they haven't rented out for more than 3 years. They can still take the primary residence exclusion, but they can also do an exchange, and that's what a lot of people aren't aware of. That was Revenue Procedure 2005-14. You got to memorize that, by the way. So that's what we're seeing is exchanges out of state. What you need to know is this. California instituted a clawback law in 2014. How many were aware of that? If you exchange out of California, example, I bought a property here in California for 100 grand. I sell for 400, so my gain is 3, right? When you exchange out of California, California requires you to file a tax return continuously every year until you sell that asset in Nevada or Texas or wherever. So California still wants its taxes on your gain, because many people think they can go to Nevada and eventually sell Nevada because Nevada has what? 0 state tax. Texas, 0 state tax. California doesn't let you get away with that. So keep that in mind. If you want to change other states, that's well and good that you're going to have that restriction. So our options now are to hold, sell, or exchange. I'm kind of biased to the exchange. As the previous speakers have talked about, what's going to be the best thing for you or for your clients. You've got to look at that. Here's just a sample of someone that has a significant amount of gain. No pictures, just kidding. If you want the presentation, I'd be glad to email it to you. My cards are on the back table. You can see this person selling for $1 million, they're going to have $348,000 in taxes due. Generally speaking, I like to say you're going to take about 25 to 30% of your equity, and it's going to go away in tax if you don't do an exchange. So what does an exchange do? It allows you, of course, to defer those taxes. I like to say swap till you drop. People say, well, how do I get out of real estate and not paying taxes? And then my answer is, thank you for playing there. Okay? Look at the difference. The first example shows that if they sell and pay the taxes, they got $651,000 to reinvest. At a 75% LTV, they can go buy a $2.6 million property. But when an exchange allows you or your clients, depending on where you are in the investment world, at the same LTV, look how much more property you can buy. And so the goal would be, well, how do I get some money out? Well, you can pull some money out and pay taxes on it. We call that boot. But the other way is, they've got a lot of lenders in the room. Can't we, if we have a lot of equity, go buy a new replacement property or properties and call our lenders and do what?
Cash out.
Refi to pull cash out to use that to buy, like Robert Kiyosaki, more property. So that's something to keep in mind. Like for like is very broad. You look at all these things that you see up on the screen there. Like for like can include oil and gas leases, DSTs. We're seeing a lot of exchanges into solar fields, cell tower sites. A lot of options of what like for like. The biggest misunderstanding is if I sell a rental house, I have to buy another rental house. True or false? False. So I want to make sure people that are new to this topic, it's very broad in what you can go into and where you can go. You cannot exchange to Canada or Mexico. I'm sorry. Only within the United States. Fractional ownership. So I'm going to touch on DSTs and I'm going to call out Jamie. Jamie, stand up. This is Jamie Furlong. She is with a company called Legacy Real Estate Investments, and she and her partner work with people in Delaware statutory trusts. Think about it this. If you've got a large company like Inland is one of the big REITs out there that buy properties, they buy apartments and medical buildings all over the United States. If you have the ability to get rid of the T's, tenants, toilets, termites, trash, and taxes, and exchange into something that has professional management, and all you need to do is receive your check. Well, you don't receive a check anymore. It's all mail. It's not even mailbox money, is it? You heard that term? It's all electronic transfer. And you can make a 5.5% cash-on-cash return. Would you be interested in doing that? So that's something that you want to look at with the Delaware Statutory Trust. And hopefully Jamie has a lot of cards with her because it is an option. As our market is adjusting to whatever the terms that we're using these days, people might want something that they can invest in. Downside to this, your money's going to be locked up for 5 to 8 years. It's not a liquid investment, but it is an investment you can look at buying and have a nice cash flow out of the transaction. The important thing of why I brought up Jamie's name is if you're a real estate broker, you cannot earn a commission unless you have like a Series 5 or Series 7 license to do that. So these, you have to go through a financial advisor to invest in them, and the client has to be an accredited investor. Anybody heard that term before? Net worth of at least $1 million or make over $250,000 a year. So, and that's net of your primary residence. So it's just an option for people to look at. Covered that. Just real quickly, the exchange equation, because I'm getting the 5-minute sign here. You'll hear the term buy of equal or greater value when you do an exchange. That's generally the idea. But in reality, you get to take out your closing costs and commission, your escrow, title fees, your commission to your realtor. For full deferral, do two things. Reinvest all of your cash and take on equal or greater debt. That's the general idea when we do an exchange. Okay? I'm just going to touch on this real quickly. If you're new to exchanges, it's simply a sale and a purchase of investment property. Just like primary residence, we're selling an investment property and buying a larger investment property. The hardest part about doing an exchange is what, anyone? Finding your suitable replacement property. Trends in 1031. I don't have time today, but learn about reverse exchanges. If you have the ability, or you have a client that I call them the angel client, those are the people with cash, because if we do have REOs come back, and we saw this a lot during the recession, is there are people, Ethan Conrad, how many of you have heard of Ethan Conrad, developer here in town, did a number of reverse exchanges, bought a building at Sierra College and Douglas for $75 a square foot, an two-story office building. Did it through a reverse exchange. Allows you to buy your replacement property first and then have 180 days backwards to sell your old property. But the hardest part about a forward exchange is that blue line right there, finding your suitable replacement property, identifying it within 45 days. There's nothing to hold you back from finding and even having your replacement property under contract before you close your old one. You'd probably make your offer, though, contingent upon the old property selling. I'm not going to go through the ID rules because I have time. And I don't have time for, are we going to do question and answers? Okay. So that's my contact information. You see the top line there, 916-832-1031. You can also find us out on social media where we have, if you want more in depth, we have a webinar on our website. So we have it on YouTube. We're on Facebook. You can find me on Facebook, but you will get everything from me. You'll see me with a Bloody Mary at Sugar Bowl one day, and then something about it changes another day. So just to forewarn you, those who are friends with me on Facebook will agree with you on that. That's it for me. Thank you.